The bank makes trillions of dollars off biweekly payments while it seems like they're helping you. But this is even bigger than making trillions of dollars. So this makes even more money than trillions. Watch this. We're going to put this on the screen, and we want to know, why does it only go down so very little, about $1 each month? So remember, our interest rate here is 4%. I'm going to show you how the bank does the math to charge you all of that interest every single month, and how they can turn a 4% loan into 71% loan, almost 72. Okay, I'm going to show you how they turn a 4% loan into 71.87%, almost 72, and they make more than trillions. Watch this. This is how they make all that money. And remember, banks don't manufacture anything. They don't produce anything. They just rent money. Interest is nothing more than rent on your money. They just rent money. All right. This is how they make $1 cotillion. All right. So we're going to put into this calculator our interest rate in as a decimal. That is 0.04%. Okay. Here's what they do, folks. 0.04. They break this thing down. All right. They break it all the way down. And then what they do is they take this and divide it by 12. All right. When they take that divided by 12, it comes out to 0.00 and then a bunch of threes. Do you see that? 0.00, then a bunch of threes. Then they take that number and multiply it by your principal balance each and every month. Watch this. So if I make my mortgage payment here, I'm left with a principal balance of $155,775.23 after my first payment. Okay. Then they take the principal balance and multiply it by 0.00 and a ton of threes. Okay. That's what they do. Now watch this. So we're going to multiply that by 155,775.23 equals $519.25. That's the exact same number that's on this line here. What? So it's not 4% of the whole amount that I borrowed. What they're doing is they're taking 1/12 of the interest rate and multiplying it by the unpaid balance, not one time, but 360 times. Folks, it's not one mortgage you're paying here. You're paying 360 separate mortgages here. That's how they get that number. Now we're down here. All right. We're down here on line 2. Now we're down to 155,549. Well, maybe that was just a fluke. So let's do this again. All right. We're going to put in 0.04 divided by 12 equals this. And now we're paid down to 155,549.71. Let's multiply it by that number. And if I'm right, we will get $518.50. Now, I know some of you are actually doing it yourself, but that's okay. All right. Watch this. So we're going to take that number and multiply it by 155,549.71 equals $518. Do you see that it says 518.499? And in banking, when that third number is 5 or higher, they round up this number. So it becomes $518.50. Do you see that? That's how it's done every single month. That's why it's so expensive. So what we do, we show you how they can charge you fewer months. So instead of paying 360 times where they can charge you, what about just paying 90 times where they can charge you? Turn your 360 payments into 88 or 90 or payments instead. How does that work? Watch this and I'll show you. Okay, we're going to break this down. So here's payment number 1. Let's say payment number 1 is in January. $224.77 goes to principal. $520 goes to interest. And when we make our payment in January, if you have an amortization schedule, you can actually see February's principal payment. February's principal payment is $225.52. Now, if you make your payment in January and you understand prepayment of principal, you know you don't have to wait to give the bank that $225.52. You could give it to them in January. Because if you wait till February, you give them the $225.52 and it costs you $519.25 to do it. But if you give it to them early in the same month, it goes to principal and you're paid down to line 2 already. See, this money here is your equity. You're buying your equity with $519.25 to get $225.52 worth of equity. You give them this money early, you're paid down to line 2 in the first month. You're paid down to $155,549.71, and your next mortgage payment for February now is on line 3. You just eliminated 1 month of your schedule by giving the bank money that they were expecting, but you gave it to them at a time they weren't expecting it. You control the time, you control how much you pay to manage this loan. That's it. It's timing and it's math. You control the time, you control the interest payment. So you give them the $225.52 early, you don't have to pay the $519.25. You just got your $225 worth of equity for free. It didn't cost you $519. And now your next payment is on line 3. So not only did you skip a payment, you skipped a huge interest payment as well. Now, I need you to take a look at line 12, cumulative principal and cumulative interest. Look at line 12, $2,747.24. That's how much principal you pay down. That is how much equity you produce in 1 year. The bank wants to charge you $6,190 in interest to produce that equity. But there's no rule that says that you got to pay the money back, the $2,747.24, but there's no rule that says you have to do it in 12 monthly installments. That's all the principal payments added up for 1 year, $2,747.24. But there's no rule that says you have to do it in 12 monthly installments. If you have it, I'm just saying if you have it, you could give it to them in January in the first month. You can give it to them on your first payment. You're paid down to line 12 in 1 month. Boom! Your next mortgage payment for February is on line 13 of this schedule. Boom! And guess what just happened? You didn't pay $6,000 for that equity. You only paid $520 on line 1 for the same amount of equity. Folks, that's a savings of $5,678.38 and 11 mortgage payments gone. You just eliminated 11 mortgage payments you never have to make and $5,678.38 worth of interest you never have to pay by giving them that money early instead of in 12 monthly installments.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.